Hello and welcome to NDTV Profit as we decode the third quarter earnings. We are joined by Saugata Gupta, the MD and CEO of Marico, to give us some insights on the demand scenario as well as how FY25 could shape up. Saugata, thank you so much for joining in. Marico's volumes grew 2% in Q3. In fact, it grew in low single digit for the third straight quarter. Could you give us a sense of the rural versus urban demand in Q3 and the outlook as well?
I think two things. First, obviously, you are right that it has been low single digits for the third consecutive quarter. Having said that, I think this quarter was slightly different in the sense that we took a significant stock reduction in GT so that they become viable for core growth. And therefore, I think if we had not taken that correction, that growth would have been 4%, which was slightly better than last quarter. Now, I think two things. If you look at the last couple of quarters, there was significant inflation, which led to consumers, especially in rural, either downtrading into smaller brands or titrating consumption. I think inflation is largely tapering off. We also seeing most of the players, including us, taking pricing corrections. I think the government continues to invest significantly in the rural segment. So we believe that going forward, especially from quarter one next financial year, rural volumes will definitely improve. We are seeing at least the first sign, especially in our core brand Parachute, where offtakes have started picking up. And then when the offtakes pick up, obviously it is followed by secondary and primary. As you know that because of the stress, a little bit of stress even in the trade, the STRs, the stock holding at retail also had gone down by 3 to 4 days. That has also led to some of the lower volume growth. But the offtake trends, for the first time, we are seeing reasonably encouraging offtake trends, which should translate into better volume growths as we move into the next quarters.
Right. So as price cuts anniversarize, as well as modest inflation in copra helps, which you just mentioned, could you give us some numbers on the volume growth in Q4 as well as going ahead in FY25 in the core categories, that is Parachute and Saffola?
I think the way to look at it is we expect the volume growths to definitely improve. And I think as we move, I think you will see definitely from quarter one next year, volume growths moving from the low single digits to slightly higher volume growths. It's very difficult right now to give an outlook. Having said that, I think we believe that at least in our core business next year, the volume growths will be definitely better. Saffola, as you know, suffered from a period of hyperinflation followed by hyperdeflation, and we also took some conscious calls to maintain threshold levels of margin. We expect Saffola also to move into mid-single digits volume growth next year. Also, the fact that there is no deflation that will translate directly into revenue growth. The other area where we believe we will again accelerate growth this year. We had to do some consolidation in our food business to get our back end right, especially our supply chain, our cost structure, and also our stock freshness norms, which we are now back, and therefore food also is expected to grow 20% plus, and digital continues to grow. So I think overall there will be better volume growth next year. And also, as far as bottom line is concerned, we would like to strive to deliver low to mid-teens bottom line growth next year.
Right. So coming to the food business, you did mention about the 20% growth. If we look at Q3, it's grown 18%, which was largely benefiting from the Plix acquisition. So you are also guided for a 850 crore revenue guidance for FY24 earlier. Do you stick to that?
I think food is likely to be more in the 750. And as I said, that this year we slowed down deliberately a little bit of a food business also because of the fact that we believe that we need to set it up for growth profitably. I think, yes, you are right. Without Plix, the growth is in single digits, the food organic growth. But as we are pretty confident that most of the we have done the setup, which is basically the gross margin improvement, which is significantly better than Saffola edible oil. our entire supply chain ability to therefore maintain stock freshness, because as you know, food has a far lower shelf life than our food compared to some of the other products we sell. And therefore, I think we are in a position to, we are much more confident of getting back into the 20% growth momentum and doubling food in over the next 3 years.
All right. And as far as the premium personal care portfolio is concerned, that has also sustained double-digit growth, led by the digital first portfolio. So, what is your growth outlook for the D2C businesses?
It is on a strong momentum, and I think the biggest improvement which we have done is the burn rate. I think as far as the three businesses are concerned, I think we expect definitely, Beardo has turned positive, is turning positive this year. The other businesses will get into far, almost nearly break even, Just Herbs. And so I think we believe that over the next 3-4 years, while maintaining a certain level of growth, one of the things we should be able to do is by 2027 getting into a double-digit EBITDA for the entire digital business. So the entire diversified portfolio of food and digital will get into not only a significant scale but also profitable by 2027, in terms of, and meaningfully profitable by 2027.
Okay, just a follow-up, you did mention about break-even for True Element and Just Herbs. So, is that something that you're looking at for FY25?
Yeah, next year close to break even. Yes, that's right.
Got it. You did mention about the structural stock reduction in trade inventory that has slightly impacted your volumes as well. You have that is the first, steps towards this overall strategic initiatives that you're taking to revive the general trade channel. Could you give us some color on what are the other structural initiatives you are taking to revive this channel and how important this channel is for the FMCG sector overall?
As you know, obviously, in India, it will be an and growth. While organized trade will continue to grow, we strongly believe that general trade will continue to play a significant role compared to what has happened in other Western markets or some of the Southeast Asian markets. And general trade will continue to be a primary lead channel. As you know, that especially in rural or in what I call small urban towns, direct distribution is a source of competitive advantage. It has high entry barriers, and that's the long-term source of competitive advantage for large-scale FMCG players. So therefore, I think what has happened is that in the last 2-3 years, 2 years, especially post, when the food inflation started, and obviously during COVID, general trade performed well. And also some of the smaller players were not in the market. They came in, they impacted during the food inflation times. In some of the big markets, obviously, organized trade has today a significant share. So the revenue from, and especially for us, when there was deflation, the revenue from the GT business has fallen. Now, when a fallen revenue, you have a cost structure which has improved, which has increased, because at any point in time, the cost of doing business increases. So we are looking at the various ways so that we ensure that the profitability and the viability of the general trade is in place to drive growth. Because if we have to drive whether rural growth, whether we have to drive distribution expansion in in urban and cosmetic channels and chemist channels and food, which is essentially for a diversification, we need to have a very viable general trade, especially our distributor partners, so they're able to also deliver better service in the market, build better credit. And therefore, we are looking at a series of steps. I think we have taken the first step in terms of a little bit of stock reduction. We want to do some more steps, which we will be able to talk to you as we finish the next quarter.
Got it. In terms of your gross margins, it has expanded sharply to a multi-quarter high on input cost corrections, along with the mix change. Even the EBITDA margin has also expanded smartly, despite double-digit growth in the ad spends. What is your projection for FY24? Is this sustainable, and also what is the guidance that you would like to provide in terms of your margins?
as I said, that we need to, have some mixture of levers to ensure that, we maintain these margins. It could be improvement in, profitability from food and digital business. We expect the impact of currency deflation to be slightly lower, especially in the second half of the next financial year. On the first half, it will continue. And then we also expect, obviously, volume growth to come and revenue growth to come, because there'll be no deflation next year. So I think overall, we will be happy if we can deliver low to mid-teens profit growth next year.
Okay, and in terms of your gross margin, what would be the guidance there?
I think again, I think we would be able to give a fairer view as we have a outlook on the commodities and the input costs sometime towards the end of the quarter one.
All right, got it. Okay, so in the food business, you did mention about 20% growth. So that's organic growth, I assume. In terms of inorganic, would you be looking at, further acquisitions?
So again, it's too premature to talk about it. But as I said, that we personally believe that inorganic growth has to be a multiplier for growth and not a escape button for not able to do organic growth. I think we have enough on our plate. We believe we have now 3 exciting food brands, and therefore we should be able to first focus all our energies to drive 20% plus growth and then look at other things.
All right. And lastly, to take this ahead, on the consolidated basis, when do you expect the revenue growth to turn positive? We have also seen again, 3 quarters of decline in Q1, Q2, and Q3. So, how do you see Q4 panning out?
Full will turn definitely positive, because I think most of the price reductions are anniversarized, except a little bit on Saffola. Most of it is anniversarized. So Q4, you will see whatever volume growth translating into revenue growth, even plus 1%, but plus minus 1%. But I think it should be there. And unless, there is something on currency, but I think broadly we are there, I think, in terms of delivering positive revenue growth.
All right. So talking about currency, you see the Bangladesh performance improving?
Bangladesh, I think, got impacted by transient, headwinds. But I think in terms of this quarter, we seem to be back on track. As far as the currency is concerned, the depreciation, I think the impact will continue for some time. But I guess it will slowly neutralize as we step into the second half of the next year.
Okay, got it. Thank you so much, Saugata, for talking to us. It was a pleasure talking to you as always. All the best.
Thank you. Bye-bye.